things have compressed. And so the public markets were near all-time tights, and below investment-grade private credit, we've seen spreads compress, we've seen terms become more aggressive. And so that is obviously an indication of, again, a supply-demand imbalance. But why we're comfortable, and I think from a macro perspective, we're still quite comfortable, is if you look at the macro data that's coming out still, you basically have an easing cycle. So the data suggests that the economy is weak, but not too weak. So there's still a fundamental underpinning of growth expected. And this U.S. economy has been remarkably resilient, probably more resilient than many of us would have expected with some of the bumps it's had. And then the growth that we're seeing also in Europe and in the Middle East and even in Japan. So while, yes, credit is tight and it could cause you to really pause on investing in credit, there are some macro fundamentals that would suggest it's still a good place to put your money. And the other element of AI, which I think is super interesting from a credit perspective, is what's going on in energy transition. So all these data centers need a lot of power. And power historically has been an infra play. And the investments we're seeing in this country and other parts of the world create really compelling investment opportunities for credit investors. They're highly structured, they're contracted with investment grade counterparties. The structures are very resilient. And so again, it's an AI derivative, an element of AI that I think is very exciting and also safe.
Yeah.
Safer.